David Darst here to give you a recap of the month of March. Now, it's been said in literature over many years that March comes in like a lion and goes out like a lamb. Well, this month, basically, the level of uncertainty, volatility has continued. At times, it's felt that the conflict was going to decline. Other times, it was going to escalate or just continue indefinitely. You have the NASDAQ during the month was pushed into correction territory. These are the technology stocks. That means they're down over 10% since their peak earlier this year. The conflict has basically been seen as prolonging and raising the economic costs, not only for countries in the region, but also in developed markets around the world. You're talking Europe, you're talking the United States, you're talking Japan. You've seen buildup of troops and ships. You've seen ceasefire, talking about ceasefire, talking about negotiations, then denying that they're going on. The Strait of Hormuz, of course, has been essentially closed for a lot of the traffic. Some ships are getting through, but you have a huge percentage of the world's oil, 20% oil, 20% natural gas of the world's flows, and even 30% in that neighborhood of helium, and of course fertilizer components also being slowed down considerably, if not stopped. You've had talk about a diplomatic off-ramp that has not come to fruition. There have been deadlines imposed. There's been some back and forth rhetoric from both sides. Anyway, you have towards the end of the month, they were talking about you better reopen the waterway or you're going to see destruction of some of the energy infrastructure. Anyway, essentially a resurgence of geopolitical uncertainty. That's been the message of this past month. There have been unrealistic demands, I think, made by both sides. The OECD, the Organization of Economic Cooperation and Development, they have put out a forecast that inflation in the United States will be 4.2% in 2026. So that generated some headlines towards the end of the month. The economy for the fourth quarter, the latest number, 1.4% for the United States. Current GDP now forecast of the Atlanta Fed for the first quarter is 2.0%. So you see one of the four pillars, that's the economy. So far, there have not been any meaningful reduction, but it is slowing and in the fourth quarter, and we'll see whether that number maintains for the first quarter. The Federal Reserve, their second pillar, interest rate cuts this year. With oil prices higher, with interest rates higher, inflation worries higher, that means interest rates higher. The Fed chances of a cut right now, you've got 6 more meetings of the Fed the rest of this year. You've got the April meeting. There's actually a 6% chance of an interest rate increase, 94% chance of no change. The June 17th meeting, only a 17% chance of an increase. The July 31st meeting, 26% chance of an increase. September 16th, October 28th, 41% chance of an increase, not a decrease, and 48%. And then you go all the way out to the year end, it's the same 48% chance of an increase. That means 52% chance of interest rates essentially staying where they are now. You pull all this together. During the month, the Standard & Poor's, as of late in the month, was down 5.8%, 5.4% negative territory year to date. NASDAQ was down 7.9% year to date. And as I mentioned earlier, it's actually moved into correction territory from its high earlier this year. Volatility has spiked this month. We've always said that when volatility is high, it's time to buy. People are not buying right now. You've gone from a volatility, the VIX index, of 19.86 at the end of February to 27.44 in the closing days of March. Russell 2000 down 5.3%. It's up less than 1%, but it still is in positive territory. The Consumer Price Index for February, the core, 2.5%. The Producer Price Index, 3.5%. And that means, and that's core. That's even after inflation of energy and food prices. Anyway, you're basically going to see, I think, the mortgage rates have risen. That's going to put some downward pressure. The two-year Treasury closed at 3.96 in the closing days of March. It's up. That's up 46 basis points since the beginning of the month. And that's reflective of expectations about the Federal Reserve's interest rate policy. So there you have, it's in black and white. It's there, 396. The 10-year, 442 towards the end of the month. And that, too, is indicative of the inflation outlook. The real yield, we watch these real yields, and we're getting now 2.10% for real 10-year yields. That's a generous real yield. So we've told some people to look at Treasury inflation-protected securities, look at other ways of locking in these real yields. And the alternative investment space is certainly a place where you can look to enhance return, dampen volatility, again with selective and very judicious and appropriate selection of managers and sponsors. Oil at the beginning of the month was $67. At the end of the month, it was $97. That's for West Texas Intermediate. And you heard these numbers. The Brent was up over $110, $111. Oil was up 45%. As you might imagine, with interest rates up and the dollar up, gold was down. Gold was down 16% during the month. It started this month at 5,230, 5,230, and closed the month somewhere in the range of 4,375 or thereabouts. So putting all this together, it's a time not to panic. It's a time to make small moves. If you have liquidity, if you need to raise liquidity, make small moves. Don't make big heroic shifts. Take your time. Be careful in the selection of managers and sponsors. You're looking for ones that have experience in working out, and seek to take advantage of these dislocations. That's what we are attempting to do, and what we're recommending. Take advantage of some of these dislocations in the private credit, artificial intelligence and software space, and the business development companies. With that, we wish everyone a great month ahead, and we hope April is a little bit less volatile than the month of March. Inshallah.